Welcome back to Business Daily. Now, joining me virtually to further have our conversation, continuing analyzing the outcome and impact of the MPR rate being retained at 27%, is Dr. Emmanuel Bashayi. He is joining us virtually from Kano State. Good morning, Doctor.
Hi, good morning, Chiamaka. Yeah, it's good to be with you again.
Yes, good to have you. Now, let's start off before we get to the conversation proper itself. Let's take a look at some of our stories. We're seeing that the equities market, the movement on the floor of the Nigerian Stock Exchange went in a negative direction, where the market lost about 443 billion naira. Now, do you think that has anything to do with the MPR rates being maintained? Because I know that, yes, Tuesday the meeting happened, but at the time when the numbers were out, the stock exchange would have closed. They closed by 2 o'clock, right? So by the time the numbers are being released on Tuesday, nothing is going to happen. And there were gains on Tuesday because most people, most analysts, most experts were hoping that the rates will go down. Do you think that this rate being maintained at 27% affected the movements and the tradings on the floor of the exchange on Wednesday?
Well, it's a yes and a no.
Okay.
Because these decisions are typically taken, putting a lot of factors into consideration. So the MPC rates might not just be the only factor in consideration. Sometimes within the month, we saw a dip in we saw some losses in the stock market as well, which was, it had no direct correlation with the MPC rates. So it wouldn't be totally correct to say that is it. And it's also not correct to say it has no hand in the matter. So that would be my response to that. But I think it's a bouquet of many, many things that could impact on the decision of investors, and also the advice being given by the stockbroker in terms of what goes on within the dynamics as to how they come about buying or selling decisions of the stocks.
Now, I know we're seeing something else took place in October after the rate cut of September, still on MPC meetings, outcomes and reactions. And the Nigerian money supply went to 119.04 trillion naira, and credit supply to private sector saw an increase by 1.89 trillion naira. Why is that so? I know the stories are trying to make it look like, oh, after the rate cut, this is what happened. Is there a correlation? Could we say they're linked in any way, these certain upward trends?
So there is a link. When MPC rates get reduced, what happens is becomes a bit of an attraction to investors, foreign investors who want to bring their money into the Nigerian market. It shows stability, and they're able to bring in more funds, be able to yield long-term interest, especially in very non-volatile instruments like treasury bills and all. So there's usually a direct correlation between rates and the investments that come in. So there's no wonder, there's no so much of a surprise that we saw more funds coming in, and then that's the expectation of the MPC, that when more funds come in, especially when they come in foreign currency, it helps with dollar availability in country, and then also eventually the exchange rate, which directly impacts on the core inflation. So we expect that now that they've halted the increase in the MPR rates and they've kept it stable now versus what it was in September, it's my expectation that if the indices continue to improve, then we should possibly anticipate a rate cut in the month of January when they meet again. But even if that doesn't happen and they decide that let's see how we can monitor the gains and reap more of it, then we might see a stability in the rates come January when they meet again. But overall, it shows that whatever they have done is beginning to yield some results, and then they can begin to consolidate and capitalize on those gains to continue to manage things even better.
All right, thank you. Now, let's get into our conversation for the day, which is about the rate cut. But before I get into all that outcome of that 303rd meeting of the MPC, we realized that this year the meeting's schedule changed. It used to be a monthly affair, but it's become, ever since Cardoso came into power, now a bi-monthly affair. What do you make of that, and how well do you think it has impacted the situation in the economy, and why was the reason for this decision?
So, I mean, different leaders come with different styles of leadership. And then if I can mine into Mr. Cardoso's brain, I mean, Dr. Cardoso's brain, I will say, some of these policies take time to begin to yield any results. So maybe 1 month in his assessment might be too short a time to see any significant difference, and hence the choice of 2 months. But I think it's still a very perfect choice of having 2 months to be able to monitor things and come up with the right assessments and the right decisions. And if I would recommend, I think it's a good stance, and I think they should just continue. There's no point changing a winning strategy. So this is a winning strategy, able to take a decision, pause and watch it before you know what the next line of action is. And I think Dr. Cardoso has done that pretty well with his team. And I think it's a good way to sustain going forward.
All right, now, the 303rd MPC meeting took place November 24, 25, 2025. That's Monday and Tuesday of this week. And, of course, a lot of analysis prior to that meeting. I asked a couple of people on the program too last week what their thoughts were, what were they expecting. Some said, oh, we expect that it goes down. Some says they might hold it, but we've seen that they've held it. Now, in case you didn't join us on the program yesterday, you're not aware of what happened at the meeting, we'll give you a brief overview of that again. Now, the MPC retained the monetary policy rate at 27.0%, leaving interest rate unchanged for now. Other monetary policy tools also remained unchanged in a way. Now, the liquidity ratio held at 30%. Cash reserve ratio maintained 45% for commercial banks, 16% for merchant banks, 75% for non-TSA public sector deficits. Now, the standing facilities corridor was actually revised. If you remember, in September, it was plus 250, minus 250. But now, it's plus 50, minus 450 basis points around the MPR. The CBN noted that maintaining the fixed rate at this level would help sustain disinflation and support foreign exchange and macroeconomic stability. Now, that's the information that has come out. And why people were hoping that the country or the MPC will reduce rate was because in October, inflation went down to 16.05% for the month of October. Now, Dr. Bashayi, you've heard these numbers. I'm sure you're well aware of the information, and certainly you've got yourself apprised with it. What were you hoping to see, and did they meet your expectations?
So yes, they met my expectation because I was between the two. My recommendation, I think one of the sessions I had told you, I would prefer they keep the rate, they hold the rate, at least for 2 consecutive. The last meeting they reduced the rate. Now they need to hold it and then watch things grow. So I think for that they met my expectation. I think that's pretty much the opinion of many analysts and economic experts as well. So in the month of January, especially when we go through the December holidays and all, I'm sure they will have some very strong indicators to come up with a very informed decision as to whether they will keep the rates or want to reduce it. But I think the days of jacking up rates, I think we're out of that. Inflation has consistently come down, which was the main reason why we had to tweak those rates and all of that. So I'm hoping that in January meeting, the likelihood of holding it might be maybe a 45%. Then there's a 55% chance that they're going to take it down. But by how much, I wouldn't know. But maybe if 500 basis points, 0.5%, as the case may be. But I anticipate that there's a higher chance of a rate cut by January, especially if these indices continue to improve as they are.
Okay.
That's my opinion. Sure.
So what are the pros and cons of keeping the rate at 27%?
So the rate alone is one thing. There are other indices that will need to also be put into consideration, like the CR. The cash reserve ratio is also a key one, because at 45% for commercial banks today, what that means is that more of the money of the commercial bank is stashed with the CBN in a non-interest yielding account with the CBN, meaning they will have less money to lend. So yes, the rates have come down, but the banks have less money to lend out to businesses and co. That is still a way of yeah, the rates are lower. Don't be happy. Don't be too happy yet to just go borrowing money. Let's keep things as stable as they can. So I expect that those measures will also continue to keep things tight at the time until we get to a point where inflation is sustainably reduced. The MPC will continue to use the tools at their disposal, but key thing is that we want to see inflation come down, want to see the volatility come down, and ultimately we have an economy that is very stable and more investor friendly, because investors care about the stability for sure.
Okay, so with this holding down of the rate, do you think it will sustain growth for the economy, while of course taming inflation? Because it's two things happening. We'll need for the inflation to go down while growth is happening at the same time. Do you think that this holding the rate will see that happening?
So holding the rates, it's a case of taking the bullet, biting the bullet on something. So between the aggressive growth of the economy and keeping the inflation stable, which one do I prefer? So I think at this stage, the CBN prefers keeping the inflation more put together than an aggressive growth in the economy. A lower MPR rate, monetary policy rate, would mean a faster growth for the economy, a more aggressive growth, but then you also risk having a surge in inflation as well. And that's the risk that the CBN doesn't want to take. So remember, the MPR rate has a more direct correlation to core inflation than it has on any other inflation measure, because the MPR rate affects FX liquidity, affects availability, and overall affects the prices of goods that depend on FX to be brought into the country, like manufacturing equipment, like raw materials for production in country, like other finished goods, electronics, and all that are not produced in the country. So this is a hard nut for the CBN, and it's a hard bullet to bite. And it's a case of which one would we sacrifice at this point. I think the Nigerian economy is it's quite fragile at this point to sacrifice the rates over economic growth. And that's the decision that the CBN has taken. Would that be the right decision for this time? I don't think it is, but I think it works for helping to tame the inflation numbers.
Let's go back to something you said earlier. Let's go to the banking sector. You mentioned the cash reserve ratio. How do we expect to see the bank respond, or other broader financial systems, to a high cash reserve ratio? If you're saying that majority, maybe 45% might not necessarily be majority, but close to half of their funds will be held with the central bank, what do we expect to see from the banks?
So we expect to see the banks being a lot more prudent. So think about, for example, if you used to have 100 naira as disposable income, and you could buy even some things that are not particularly very necessary. You go window shopping, you just blow the cash. Now you have 55 naira that you can do that with. What that means is you're going to now start prioritizing. You do a scale of preference. Which one is the most critical? Which one can I do? Which one is nice to have? Which one is critical? And which one is must have? So instead of eating that suya by the roadside, you now decide, hey, the money for the suya could be channeled into something else. Now, this is the typical real life scenario that banks are faced with. So the banks will now be faced with uh, the lending, which of the lending is more critical, safest lending, the most critical that would drive the most impact is the one we would rather focus on than focus on lending that has to feed frivolities and the rest of them. Now they have less money, less of their total deposits to be able to give out as loans and all. So they're definitely going to prioritize which one should fly and which shouldn't fly, because it's a policy measure by the CBN and they're highly regulated.
Now, October inflation at 16.05%, basically 16%, made a lot of people think that they would actually cut rates down maybe by 50 basis points. I think someone even said 250 basis points at some point, but you know, that didn't happen, and here we are at the cuts being maintained. Now, with that number, and hopefully come December, with the November inflation report should be hopefully going towards a downward trend. But at 16%, what's the leeway that central bank has for monetary easing?
So the leeway they have for monetary easing would be two-pronged. It will first be around the rates, which they will not be able to touch until they meet again. And the second will be around the CRR. These are two major things that they can be able to tweak. And those will only happen when they meet again. But then what is critical is that as we go into the Yuletide, as we go into the festive season, we expect a lot of Nigerians to come into the country who live abroad, meaning we should expect a relatively higher inflow of foreign exchange. And when that happens, there will be significant availability of the FX within within the spaces where importers and the rest can be able to have access to them. That will help significantly ease the pressure on the Naira, and we should see Naira strengthening because of the inflows, which is what the CBN seeks to achieve. More inflows mean more availability, and more availability means less volatility. Okay, so it's my hope that as more people will spend in the festive season going into December, it will make the cash, the FX more available, and that will eventually help to tame the core inflation, and hopefully it should bring down the inflation number as we go into the next year, because the key driver of our inflation now is core inflation. Food inflation came down by 3.75% September. So core inflation only came down by like 0.89. So you would expect that if that comes down, it will help the overall number, because the larger part of the inflation number. Food inflation is still coming down now because it's harvest season, and then a couple of other things have also helped to bring it down. That's why you see a sharp decline in the food inflation, but the core inflation keeps driving the whole number because the larger chunk of the inflation bucket.
All right, now, is there any reason, or rather, let me find a way to rephrase the statement. What could happen with disinflation? What could it be stalled if rates are relaxed, early, or too quickly, or too early, as the case may be? What could happen with the rate of disinflation that we're experiencing so far if the rates are relaxed too early? You were saying, good thing, ease now, hold the next time, and maybe ease the next time. But peradventure, they had, not held the rates for the month of November and had eased it. Would it have in any way affected our disinflation trend?
So it will be a case of give and take. What you lose on one side, you can gain on the other side. So if we, even if the inflation doesn't go down as fast, we'll gain it by a faster growth in the economy. So one will give up for the other. So imagine if I have a rate, inflation rate come down by, say, instead of the close to the 1.97 that we have between September and October, then I now have, let's say, instead of coming down by another 2% in the month of November versus October, I now say, okay, let me have a 1% reduction, but then I also have a 2% growth in the economy. So you see, one gives up for the other. Today, with the tightening of the MP, with this, the holding of the MPC MPR rate, it would have slowed down the growth rate of the economy, but then it has cut down the inflation effort. Cut down the inflation number. So one gives up for the other. So you need to be careful at what point you draw the line. You don't want to grow the economy too quickly, risking a growth in the inflation number again. I also don't want to reduce the inflation so quickly that you stifle the growth of the economy. So you have to strike that balance. And I think it's striking that balance becomes a combination of many things, both the fiscal and the monetary policies, which is why the CBN is also being very, very concerned and considerate in trying to tame that number. But then it's a case of one gives up for the other. An aggressive economic growth will risk an increase in inflation, for sure.
All right, now we're still going to stay around inflation, but what non-monetary factors? Because we're talking about the MPR and its impact on inflation, but away from monetary policies, what non-monetary factors could still be driving inflation? Yes, we're currently on a disinflation rate, but anything could happen. Anything could change. What are these non-monetary factors that could actually drive inflation, and what could our government do to address it?
So non-monetary factors, so core inflation is driven mostly by monetary factors. So we keep that aside. But then for food inflation, that is driven by most of the time non-monetary factors. And then when you think about food inflation, you'll be looking at food itself, and then you're looking at non-alcoholic beverages. They form like 52% of the food inflation basket. Now, there's been a continuous debate in the last couple of months around the price of bread, for example. Now, the price of bread kept going up because the price of flour kept going up. Today, the price of flour has come down. So the question Nigerians are asking, why has the price of bread not come down? So you see, issues like this, inputs come down and then the output remains, the price of the output remains stable or stable. It's a concern for Nigerians. And then by the time we start seeing a reduction in the prices of non-alcoholic beverages and the rest, it could begin to have an impact also on the overall food inflation number. All right, because today, naturally, because of the harvest, food prices will come down. Food prices of rice, food prices of yam, and the rest of the staple foods will come down because of harvest. But then, if these non-alcoholic beverages, who together with food form more than 52% of the food inflation basket, if that doesn't come down, it skews the balance and doesn't allow that to happen as effectively as it should. So while the MPC is doing their best to work on the monetary part, we also have concerted efforts around how these food inflation numbers can come down. The second thing is security is still an issue. We have pockets of insecurities in different parts of the country. That is also impacting on food availability and even the prices of the food. So this also forms part of the reason why it's impacting on the sharp decline that the inflation numbers will have, because these factors are still very much with us. While one is coming down, one is being aggravated, and things are not particularly the same all the time.
Okay. Now, earlier in the conversation, you kept on talking about, when we come in January, when they'll have the meeting, January, February, we'll get to know as the case may be. But that's something that you've said about the Yuletide season. How much of an impact will that really, really have on the committee meetings report when they meet, if they meet in January or if they meet in February? How much of an impact? What are the things we could look at that could make us say, okay, with this happening, we expect that when they meet come next year, this might be what will happen. Either they hold rates or they cut rate. What can we look out for as a business person, as an SME person in the economy that would dictate how January meeting or 2026 is going to go for us?
So January meeting, by my estimation, I had mentioned earlier, I should see, I hope to see a rate cut because the indices might be better by the time they meet again. The Yuletide season comes with a number of peculiarities. There is usually a surge in demand for many items, food items, beverages, both alcoholic and non-alcoholic, and as the case may be. So what that means is that if the prices remain stable and we have increased consumption, you should see an increase in a lot of the, you will see an increase in consumption, more money in circulation, less pressure on the naira, and then you'll be able to overall see a decline in inflation because the increase in consumption could overall cover up for the prices that people will want to charge for commodities. Now, that is on one hand. On the other hand, if the prices of products that affect many of us changes, like if there's an increase in the price of fuel, that will mean higher transportation costs. That will also impact on the purchasing power of people, and even those things that they typically will consume more could be impacted as well. So if we have things going as they are right now, stable fuel prices, fully available, then you now have an increased consumption because more people earn more money towards the end of the year, and then they can now spend more and all of that. Then we should be able to see a general reduction in the overall number by the time they come in January, and that might inform why they want to either keep the rates again or consider a reasonable reduction in the rates. But then this is what we expect. 30 December is here. People expect to ball and enjoy. But then we also hope that the economy will also see a sustained reduction in the inflation, so that by the time they meet in January, MPC meet in January, they could consider a favorable cut to the rates.
All right, now, our final question. What are the biggest risks to Nigeria's economy in the next 6 to 12 months?
Biggest risks from the monetary side. The first will be keep things stable as much as you can. Any form of shake, any form of temporary shock would wipe out quite a number of things. So keep things as stable as possible, as much as you can. Then from the fiscal side, please nip security in the board. Nip insecurity in the board. Ensure that food availability and accessibility is key, and affordability is key. That would significantly help the inflation numbers. And please let there be fewer surprises. Let somebody not just wake up tomorrow morning and the pump price of fuel goes to 1,500. That can then begin to snowball a whole lot of things. So I expect that things will go as quietly and as calmly as they should be in the next couple of weeks into the new year. But most importantly, stability is key right now. We're in a very fragile situation as an economy, and we need we need as much stability as we can get to keep things quiet and easy, so that we can be able to continue to reap the gains of all that we have been able to endure over the last couple of months due to the measures that we have put in place to ensure that we bring down inflation.
All right, thank you so much, Dr. Bashayi, for sharing your insights with us on the outcome and impact of the MPR rate being maintained at 27%.
The pleasure is always mine. Thank you for having me.
Well, that was Dr. Bashayi talking to us about a few things from the outcome of the meeting of the MPC. Remember, the rates were retained at 27%. And he said a few quite important things. Yes, he expected the rates to be retained. It's a good thing that has been done. But hopefully, come in January, the rates will be cut brought down a bit. However, he said a few things to be put in place. His outlook for the next 6 to 12 months. Stability is very important. Less surprises is very important as well to help Nigeria's economy keep going forward in a positive direction over the course of the next 6 to 12 months. And that's it for Business Daily this morning. I've been your host. For more of our programs, news and documentaries, follow us on our social media platforms and on our YouTube live stream. The news comes up in a few minutes. I am Chiamaka Nwafor. Bye for now.